So investing into index funds, there is nothing exciting about this game. It's actually pretty boring. You send your money over to the account, it grows at a certain point, but you have to keep putting money into that account to allow it to grow and grow and grow. It's not going to happen overnight. You're not going to experience some massive growth all of a sudden. It just doesn't happen like this in this game. So in this video, what I'm going to teach you exactly is what an index fund is, where to invest the money, how much money to invest, what index fund I choose to actually invest my money into, and also how much money do I have invested and how much money does that money make me as far as my investments. Now, the reason I'm this honest and transparent is basically I would have liked that when I was basically learning about investing a long time ago. And by the way, remember, as you watch this video, the last thing you want is excitement when it comes to your investments. You don't want that because it's like, oh, you know what? I got to $1 million, but then tomorrow I wake up, the market is down, and now guess what? I'm down to 500,000 or 100,000. You don't want excitement in this game. You want something that's predictable and you know exactly what you're doing. And that's the goal for this video, to help you get started. And by the way, it's simple to do, but it's hard to actually do. Does that make sense? Like, it's simple to understand what I'm gonna tell you, but the application takes a lot of patience and you basically just doing it over and over again. Making money, becoming wealthy is just repeating the same steps over and over again as long as they keep working, and they're working and have been working for a very long time, and you'll know how they work by the end of this video. And as always, guys, like this video, on top of that, also subscribe and hit the bell so you get notified. Now, the very first thing is this, guys, okay? When you think about an index fund, think about it like this. It's a bunch of investors pooling in their money, and they're trying to basically track a certain part of the market, or for example, a market index. And one of the most popular ones right now is the Standard & Poor's 500. Now, those are basically the 500 largest companies in the US. So me and you and your friends and my friends, we get together, we pool in a bunch of money, and to track those 500 companies, what do? We basically just buy those 500 companies. So whenever you invest, for example, into the S&P 500 index fund, that's what we're doing. We're pooling our own money, investing it into that to track that overall part of the market. It's not that complicated. It's not that crazy. And it doesn't really involve any selling that much, because the only time you actually sell something is whenever that company falls below the graces of being one of the 500 largest companies. For example, if Amazon goes bankrupt, obviously another company will come into the 500 largest, and then we have to basically sell the Amazon and buy that, and that's how it works. But it's very, very simple to comprehend. We're pooling in money, we're investing into something to try to track it, okay? That's it. Now, here's something else, guys. I know this video says on how to become, for example, a millionaire when it comes to index funds, but you really have to think about that number. Do you really want to get to $1 million? And here's why I say this, because in reality, let's say, for example, you're saying, hey, I want enough passive income. And by the way, my definition of being wealthy is having more money coming passively than you actually have going out in your expenses. So in reality, if you think about it, if you're going to be spending $4,000 a month, right? That's your expenses. Multiply by 12, that's basically what you need a year, $48,000. Now, the math is very simple. Whatever your annual expenses are, just multiply it by 25, and that tells you exactly how much money you need. In this case, you need about $1.2 million. That's a lot of money. But let's say you say, what if I can lower my expenses? Because we have four main ones. We have shelter, utilities, groceries, and transportation. Now, if I lower those ones, for example, I have a paid off home, I lower my utility bills. On top of that, I don't have any debt. I don't have a car loan. And that's basically about it. So if I can lower that $4,000 number to $2,000, well, guess what? $2,000 multiplied by 12 is $24,000, obviously. Multiplied by 25, that's around $600,000. That basically means I need half the money. 600K is a lot less than $1 million, and you can get there a lot faster. Remember, the more money you need, the more money you're going to need to invest, or the longer you're going to have to wait. You know, the richest people out there are the people that usually need the least. It's not about wanting the most, it's about needing the least, so that way you can get to your goal a lot faster. Number 3 is use common sense. The average millionaire in America is 57 years old. 10%, well, less than 10% of Americans are actually millionaires. And on top of that, it takes a while to actually get there. That is my point. So whenever you're planning this out, remember, this is a long-term plan. It is not gonna happen overnight. If you're in your 20s, you're in your 30s or 40s, remember, it is going to take a while to actually get there, and you gotta be patient, all right? It's not gonna happen overnight. Now that we got that out the way, here are the basics when it comes to how to actually invest your money into an index fund. Now, obviously, there are several different types of index funds out there. There are index funds that focus, for example, on the American market, European market, Chinese market, Russian market, oil market, just small companies, technology companies. There are a bunch of different index funds. But the most important thing you want to think about is if you're going to be investing this money for the sake of retirement, you want something that's going to last a long time, preferably something that's going to outlast you. So in reality, first things first, you want to pick a brokerage, okay? A brokerage is going to be who you're actually going to be investing this money with. Now, for example, the big ones are Vanguard, Fidelity, or Charles Schwab's, okay? Overall, my favorite one personally is going to be, for example, Vanguard, and that's the one I use right now. You might be asking me, Tommy, why don't I just use, for example, Robinhood, M1 Finance, or Acorns, or one of these apps? The answer is, whenever you're talking about retirements, you really want to think about the biggest companies, which are usually the healthiest and can withstand anything and have been around for a very long time, have great customer service, and that's why I mentioned the top 3 dogs. Compared to that, everyone is just chicken scraps, okay? So that's why I say you wanna go big and massive. Now, all of these 3 firms, okay, they all have their separate index funds with their different names or whatever, but usually they track the exact same things. They're very competitive and they're very good, okay? It's not like one is really bad, no. All 3 of them are pretty good. Now, second, you want to pick exactly what you're going to invest your money into. Now, this depends obviously on your age, your risk tolerance, and what you actually want to be involved in. Now, I had a portfolio before that had bonds inside of it because bonds tend to fluctuate a lot less. But if you're going to be investing for like 10, 20, 30, 40 years, the answer is usually stocks are going to outperform bonds. So here is my investment strategy. You can use it if you want to. I invest just into one index fund, okay? And that is the S&P 500. That's the 500 largest companies in the US. And in reality, the reason is very simple because when you think about it, if the US fails, everybody fails. It's that simple to comprehend. So when I invest my money into the S&P 500, what I'm saying is I think that 20 years from now, 10 years from now, America is going to be doing a lot better. And if it's not, well, the dollar doesn't matter, my house doesn't matter, nothing matters, okay? So that's the bet I'm basically making, that America is going to be better off later. Now, once you go ahead, you pick the brokerage, you go ahead, you pick the investment, all you have to do is pick how much money you're actually going to be investing into this account. How long is it going to take you to actually get to your goal and what your goal actually is. So overall, it's very easy to do. So first things first, I'm gonna go ahead and put this website in the description. It's called a savings goal calculator, and it calculates exactly what your savings goal is and how long is actually going to take you to actually get there. Or for example, okay, so I'm gonna put this tool in the description down below, and it's basically a savings goal calculator. You put in exactly what your goal is, like how much money you want and what time you actually want to accomplish it, and also it tells you exactly how much money you need to invest to actually get there. Now remember, the answer is pretty simple. If you're gonna need $24,000 a year, whatever the number is, just multiply by 25. I'll tell you why later in the video, and then boom, it gives you the number. So for example, if my number is $600,000, here's how the math actually works. So I go right here and I type in $600,000, and I say my initial investment is going to be $1. Gotta put something in here or else it won't work. And then I say, for example, years to grow, I wanna get to my goal in 25 years. And I'm gonna make an estimated, by the way, if you invest the way I invest into the S&P 500, you're going to make somewhere about like 11% a year, okay? So you click calculate right here, it tells you, hey, you need to invest $437 per month to actually get to your goal. Now, here is my advice to you guys. Make sure that whatever your goal is and the amount of money you're actually going to invest is no more than 10 to 20% of your income. This way, whenever you get paid, you can send that money over and not really miss that much. Before you start investing, make sure you're debt free. Make sure you have an emergency account. This way, if something does go wrong, you're not going to interrupt your investments. That's one of the most important things. And thirdly, Tommy, do I invest money into a taxable account? That basically means if you make money, take it out, you get taxed, okay? Now, or do I put it into a retirement account with my job? That basically means a 401k, Roth 401k, 403b plan, all those plans your employer basically gives you. Or do I put it into an individual retirement account like an IRA or a Roth IRA? The answer is simple, okay? What I would do is, if your employer is giving you a match, find out with the HR department exactly how much you're actually giving you and what the limit is. So if they tell me, Tommy, we're going to match dollar for dollar up to 6% of your salary. The answer is, well, the minute I invest $1, I make $1. That's 100% return. I'm going to get the maximum amount of match I can basically get from that company. Boom, that's it. Just the maximum, that's it. And then the rest of the money, I'm going to invest it into my Roth IRA. Why the Roth? Because basically, you want to have your money invested and pay taxes now, so later on you don't have to pay taxes when you actually need the money. And in all honesty, I do think taxes are probably going to be higher later on than they are today. So Roth IRA all the way. If you're able to max both those things out, like the max match plus the Roth IRA, then you can put money, for example, into a taxable account. But most people, they won't be able to max those things out because in reality, it takes a lot of money. So the Roth IRA is like $6,000 a year, and then you can get like 6% of your salary, and your limit is just like 10 to 20% because you should be focusing on paying off your home. That way your expenses are a lot lower, and that way you also need less money because a mortgage is a lot of money. Now, overall, I did promise you guys some transparency here. Tell me, how has this plan been working for you? So far, here are my stats here, okay? I've been able to basically buy about 709 shares of VOO. VOO is an exchange traded fund, aka an ETF. Now, difference between an ETF is that you can basically trade it like a stock, while an index fund, you can only really trade it about like once a day. So you buy once a day, you can sell once a day. That's basically about it. But there's no real big difference because in reality, you're investing into the same exact thing, but there is a lot more fluctuation when it comes into the ETF. And I like that because I'm able to take advantage of price discrepancies and basically make a little bit more money sometimes, okay? That's about it, but it's the same exact thing. I don't sell it. I basically just have it in there and that's it. Now, in my 401k, I've been able to basically buy about 47 shares or so, and in my Roth 401k, about 76 shares. In total, I have about 832 shares as far as, for example, the S&P 500 style investments. That's about it. Now, in dividends, this makes me about $4,833 every single year. And also, if you calculate an 11% gain on my investments, that's about $33,711. Now, if you want to find out exactly how much money I have in the investment account, just divide it by 11% and that gives you the number. But a total amount that I get annually, it's about $38,000 and some change. That's the idea. And to me, that's awesome. But if I'm being honest with you guys, I can't take all that money out every single year. Because in reality, if you think about it, if an investment is making you 11% and you take 11%, you don't leave any money in there to actually grow. It stays stagnant, okay? And that's not what you want. So my rule is pretty simple. Not really my rule, it's like a common financial rule. It's called the 4% rule. And the idea is you only take 4% of your investments as a distribution to yourself. That way you leave another like 7% in there to actually allow that money to keep growing and compounding, growing and compounding. And your 4% will keep increasing and increasing. So my 4% really makes me somewhere about like $12,000, just like as far as like what I can take out, plus 4K in dividends, about like $16,000, but that's about it. So that's why it's so important when you have, for example, your expenses that you multiply it by, let's say, for example, by 25, because well, here's what happens, okay? If I need $24,000 to basically live, and by the way, my number is, if I had to go on a beans and rice and chicken diet, That's it, okay? I'd only need, for example, like $12,000 a year because I have a paid off home, and that's awesome. But $12,000 a year is not a happy lifestyle, okay? But 24K for me is more than enough. Now, if I multiply this by 25, I get obviously $600,000. Now, if I just take 4% of that, I get the same $24,000. That's what we multiply by 25. That's the idea. So remember, if you're going to be investing the way I invest with Vanguard. I buy the S&P 500. That is it. I invest the same amount of money every single month, which can be anywhere from 10 to 20%, okay? I do 20% usually, and that's what I do. But again, you don't have to do what I do. You have to find a balance for what makes the most sense for you. Now, I recommend highly, before you start investing, pay off your debts, because you can't get rich paying somebody 18%. On top of that, have an emergency account, because this way, if something happens, you have somewhere to actually fall back on and you don't have to interrupt your investments. But as far as investing into index funds, it's not going to be exciting. There isn't a lot of fees. You kind of know exactly what's going to happen because we have a lot of figures to go based on. Now, in reality, my goal to hit $1 million is not my goal anymore. My goal is just to have in there, for example, like $600,000, and I'll be just fine. But I can basically live off exactly what I make right now and be perfectly fine. Like, there's no big deal, okay? Because again, the person that's usually the wealthiest is the person that needs the least amount of money. Now, if I wanted a fancy lifestyle with a Tesla, with a big house, with all the fancy stuff, obviously I would need more money to finance it. But I don't care for those things, okay? I'd rather spend my money on experiences, and that's basically for me, all right? But guys, as always, I hope this video actually helped you. It gave you value. On top of that, I'll put the links down below to everything. And when you check down there, you won't see any links to Vanguard or Fidelity or Schwab's, because I don't want to build any like, oh, you like this one more, Tommy? I really don't care, okay? I use Vanguard because it's the biggest one. I like it. But I want you to think I'm affiliated with them, because I'm not, all right? So that's it. Thanks for watching. Comment down below, invest, if you made it all the way to the video. And also comment down below exactly how much money do you need, all right? And what is your investment goal? How long will it take you? How much you have to invest to it? How much will you need to actually invest per month to actually get there? Basically, I want you to do all the work in this video and then comment it down below so I know you did all the work, okay? As always, guys, long-term team officially out. Follow me on Instagram, TommyBryson. More content here. My face is here. As always, peace.